Are you a high income earner looking to add real estate to your portfolio? If so, this video may be for you. I work with physicians, dentists, entrepreneurs, engineers that make a lot in their day job, and they might have some restricted stock units or other investments looking to add real estate for the tax benefit, for the long-term wealth. In this video, I'm going to go over what I feel is totally achievable for high income earners to add $36,000 a month plus to their income with real estate. Stay tuned. All right, Matt Gouget, Matt the Mortgage Guy, licensed in 48 states. Go to greatmortgagebroker.com, fill out the quick form to connect with me and my team. We're more than happy to help. We work with investors from all over the country. I'm an investor myself. I love talking investment real estate. So in this video, I've got a simple Google sheet I put together over the last 30 minutes to just walk through some numbers that are totally achievable, in my opinion, for a lot of high income earners that may be fantastic at their day job, maybe the best physician in town, but they don't know a lot about real estate. Well, that's okay. I've got great agents I can connect you with, and we've got a great loan team that has this handled because we do it all day, every day, making real estate relatively easy. And then the massive benefits you have by buying and holding on to real estate are all yours. So I'm going to show this sheet because I think that numbers matter. And for a math nerd like me, numbers are fun. This little Google sheet I made, I called Road to 10 Properties. I did this after I talked to somebody who's investing out in Columbus, Ohio. So wherever you're investing, it might be different. In California, you might have to 2 or 3x these purchase prices. In other states, maybe you can use half of these purchase prices and go from there. But with a specific investor with a high earning day job, it's not unrealistic to think that at the 225 purchase price, him and his wife can pick up a couple properties per year. I've calculated it here with a 25% down payment. A lot of investors use 25%, even though they can put a little bit less because it provides the best terms, especially when you put 25% next 25%. So follow me real quick. 225 purchase price on the first 2 properties, 25% down. I put 230 in year 2, 235, 240, just because in general, real estate tends to appreciate. And so you might expect to pay a little bit more in future years. Then based on a 7.5% interest rate, which might be lower next year, might be the same, who knows? We've got a principal, interest, taxes, and insurance payment of $1,350 a month. $1,900 rent, and this is a real life scenario in this market. Even if you use a 0.75 factor and you account for paying for a property manager, so that stuff's not all on you. If you account for turnover, if you account for capital expenditures, all of that stuff, this property still has a little bit of cash flow. And I'll show you down lower, especially for somebody who's got a well-paying day job, cash flow is probably not your main concern. Whether you make $100 a month or $400 a month is probably not going to change your life. What will change your life is when I show you $36,000 a month down the road and $6+ million in real estate assets just by holding on to them. So go through 5 years, you've bought $2.35 million in real estate, and that's down here. Highlight it for you. For this specific calculations, it's nothing super advanced. I just thought to myself, you know what? Let's use a conservative, very conservative home price appreciation of 4%. In some markets, it may be more. I'd be hard pressed to find markets where it's less. There might be some Midwest markets where you can't count on a lot of appreciation, but nonetheless, 4% appreciation. You're going to watch that 2.3 million in real estate by year 10. And the cool part is I didn't even account for any appreciation in the first 5 years. This is literally just how much you purchase the properties for after 5 years. And so to be extra conservative, let's call it flat for 5 years. Then you start gaining 4% appreciation per year. You're already at 2.8 in year 10, 3.4 million in year 15. During the time while these properties are appreciating, the tenants that are in the properties that, on a conservative estimate, it's at least breaking even. The debt is being paid down. So this total debt, which I didn't total here, but I could by just doing this, stand by, sum of this. I don't want to autofill and say the debt's increasing every year. Is that increasing or decreasing? What is it autofilling? Huh. I'll figure. No, yeah. See, it's autofilling with with the debt increasing by 4% each year. Definitely not. The debt is going down. 1.76 million the first year, and what a lot of investors I work with do is not just wait for the 30-year fixed rate amortization schedule to do its thing and have tenants pay off their properties, but they're going to throw an extra $1,000 a month, an extra $2,000 a month towards that to pay it off aggressively. And what will happen is, as the first couple properties get paid off, and now you've got $1,900 in rents, minus taxes and insurance and capital expenditures and the things, you've got cash flow on those properties. An extra couple thousand starts going, and it's like a snowball, right? So you'll pay off properties 2 through 10, and then 3 through 10, and then 4 through 10 at a faster and faster pace. And ideally, for somebody who's doing something like this, or from case studies that I've seen, you might have everything paid off 12 to 15 years down the road. But nonetheless, I don't want to, get too far down a mathematics rabbit hole. I just want to show you total rents of $19,500 across these 10 properties. We're fast forwarding 5 years. We bought 2 properties a year. So you've got 10 properties, which in total collect $19,500 in rents. If you look at national averages, 2.5% would be a conservative estimate for how much rents will increase year on year. When I did this and I looked back, to a lot of people's surprise, even during the toughest economic times, and especially here, entry-level type housing, rents are going to go up, right? During the 07, 08, 9, and 10, what people refer to as the financial crisis, rents were still increasing. So 2.5% year-on-year averages are going to take that $19,500 in rent, and 15 years from now, it's going to be $24,962. 30 years from now, it's going to be $36,152. And, that's on the rent side. Over here on the value side, using that 4% appreciation, let's say that you didn't do any extra payments, that you just collected rents and paid off these properties from the rental income, no extra payments, nothing else. After 30 years, you got 6.2 million in real estate. You've got 36,000 in rental income coming in. I'll take 350 to 400 per property times 10, and let's just call it 4,000 in taxes and insurance. We can also use this number. Someone else is managing it. None of the stress, none of the headache, none of the leaking toilets, or sending out a handyman to fix a cabinet. I'm doing none of that. I'm paying 8% to have somebody handle all that. Worst case scenario, we're talking $27,000 hitting the bank account. Take $4,000 for taxes and insurance, $23,000 hitting the bank account month after month. You cannot tell me that any 401k account, anything like that, is going to pay you those kind of dividends, which quite honestly are only 2.3 versus 1.76. This is like 600,000 in capital that was put into these properties. This isn't like you invested $1 zillion. You invested 600,000 over the course of 5 years. You've seen $4 million in appreciation, and you've got an annuity for, pretty much of over $20,000 a month. Now, this is the magic of real estate. When you're earning $400,000, $500,000, $600,000, you also need some tax write-offs. This income that you're receiving, this appreciation of these assets is going to be written off. It's going to be written off because you're going to have depreciation that you get to write off. You're going to have interest expenses while you hold the loans. You're going to have taxes and insurance that go against the income that's generated from these properties. So I'm a big fan of real estate, and I know so many people that collect real estate as another way to fund another retirement fund. Keep your 401k. Cool. Keep your stock. That's cool. Real estate should be a part of the investment strategy. To get connected with me and my team, greatmortgagebroker.com. Connect with us. We're more than happy to help. Hopefully this was helpful. If you want to look at something like this, you want to talk about your specific scenario in California, this could easily be something that's triple the value. And so you're going to go from 6 million in real estate to 20 million in real estate. And really it's not unachievable for a lot of the high income earners I work with. So hopefully this was helpful. Let me know how we can help. Talk to you soon. Bye-bye.